I love the way you go after consensus. What's consensus get most wrong right now?
Well, I think the consensus right now is pivoting feels like very quickly to peak inflation, slower inflation, maybe the Fed backing off. I think that's probably a mistake.
You think that that's a mistake, Neil, because you think that the Fed is going to keep going and that inflation hasn't yet peaked?
Well, I don't think core inflation has peaked, Lisa. There she is, Tom, my arch nemesis, now my best friend. We're on the same side of the fence. Yeah, look, I mean, at the end of the day, I think things changed at the June FOMC meeting. The Fed basically told us that it was willing to, push the economy into recession to achieve its goals. And, we went from it's going to be challenging to achieve a soft landing to now it's going to be very challenging to achieve a soft landing. I mean, the path is narrowing. I mean, they sort of use these kinds of, words to basically demonstrate how difficult the task is going to be. But, look, I mean, the last employment report was a knockout. And, essentially, we have inflation significantly above target. You heard Mike McKee there talking about unit labor costs. I mean, unit labor costs are up a lot. Interestingly enough, during the pandemic, prices have actually been trailing unit labor costs, which in my view means that there's more upside to prices going forward. And despite the fact that price inflation is so elevated, financial conditions, what have they been doing over the last couple of weeks? Well, they've been easing. So to me, that suggests that the Fed has a lot more room to go. I think the die is cast now for a 75 basis point move at the September FOMC meeting, and they need to leave it on the table for the remaining two meetings this year.
What does that mean for equities? I know that you've been a big bull in terms of the corporate resilience and their ability to adapt and adjust, to use Tom's phrase. Why is this time different, this moment different when it comes to that?
Well, I mean, equity markets, when you think about it fundamentally, it's really driven by three factors, right, Lisa? It's interest rates, actual and expected earnings, and the risk premium, right? So the move in July, the 9% burst in the S&P 500 last month, that was entirely driven by lower interest rates. So if I think the Fed's going to keep hiking, I think interest rates will go up. And, the economy is not out of the woods. I mean, we're going to see residential investment contract in the third quarter. We're going to see capital spending come down because growth expectations have softened. Inventories will likely be more negative, particularly for, sort of durable goods industries. So you'll see an inventory liquidation of some kind, I'm assuming. That's all negative for GDP growth, which is negative for growth and earnings. And so, if interest rates are going up and earnings estimates are coming down, it's hard to be optimistic about the equity market. And of course, the equity market is one way the Fed has to slow the economy down.
Yeah, on the subject of earnings, Neil, obviously the ability to retain profit margin in an inflationary environment like this one is predicated on the ability to pass on higher input costs to the consumer and consumers to tolerate those higher prices. Are we overestimating the resilience of the U.S. consumer? Consumers
have an enormous ability to take on higher prices, as evidenced by the fact that, look at how much excess savings they have. The entire improvement in consumer spending in the first half of the year was driven by lower savings rates.
But that can't last forever, right?
Bingo.
So where does that leave us, Neil?
To me, it just leaves me more cautious on the economic outlook. I'd be cautious on stocks. I get that the equity markets have kind of ripped here. Maybe a lot of the people that were thinking the way I do about things already sold back in June, but this isn't over yet, that's my view. But I think one of those reasons is because the Fed's not done yet. And you think about the rest of the world, the dollar is likely to. I don't think the dollar strength is over yet. You have a U.S. economy holding up better than many of its major trading partners. You have the Fed still hiking. That's obviously very dollar bullish.
So they're holding up better. If we get a Dutta inflation, if we get whatever the real economy will give us, and it doesn't sound like with productivity it's going to be all that much, that's still a sustained nominal GDP. So let's go to the Dutta optimism. Can we say that Dutta and Bramo agree to agree? I think we can say that, folks. This is a rare occurrence.
Breaking news.
But away from that, when you say to Bramo here in months, you're wrong, it's going to be because Dutta's optimistic. Can corporations adapt to this unique set of cards right now?
Well, they're going to adapt, but Tom, that's going to require some pain for the economy, right? I mean, if you think about the first half of the year, to me, for business economics, the most interesting thing is this reconciliation between the fact that hours worked have been rising very robustly and output has not. So we've seen this big drop in productivity. So the question is, how do companies reestablish stronger productivity? That's going to require some combination of slower hiring, fewer hours worked, raising prices.
For 50 years, it's been total factor productivity to the rescue. Is it going to come to the rescue again? Technology is an overlay?
I mean, it takes time. I mean, I don't see an investment boom out there right now. Okay. So where's the productivity going to come from?
I just want to get on us on a negative note. So Abramowicz and Dutta agree to.
Look, I mean, honestly,
well, Lisa.
This is the issue: is that a lot of people are looking at the financial conditions index, and Neil, you mentioned this, and it's actually the least. That it's the least tight, it's the weakest that it's been, it's the loosest that it's been going back to April. And it makes no sense. And this is the bear case. No, but Neil, you alluded to this, and this is where I think we agree, is the Fed's going to look at this and say, I don't think so. And they're going to push back. When do we get that pushback?
Well, it could come as soon as Jackson Hole. It could come at the September FOMC. You've started to see it particularly among a lot of the regional Fed presidents, right? I mean, they've been saying we're not done yet. Look, I mean, the other thing, of course, is that they'll try to be hawkish, but they sound dovish in the process. For example, they'll say something like, well, it's the market's it's too soon to be pricing in cuts. Well, you shouldn't be pricing them in at all. So why are you even giving the market that sort of language? I think what the Fed basically needs to say is that we have a singular focus on bringing inflation down. And we're willing to do what it takes in order to do that. And there are no cuts coming.